We've been ignoring some fundamental tools, and it's time we start using them. For instance, if we zoom out a little bit here, if we zoom on out, there is a very obvious Fibonacci retracement here. If you notice, we've got Fibonaccios, Fibonaccios, Fibonaccios. There is an entire bag of Fibonaccios right here. You can see where the Fibonaccios are going here. Let me label this so you guys understand what's going on. Fibonaccios, an entire bag of Fibonaccios. We've been completely ignoring in our discussion of Cardano. But you notice where this bag of Fibonacci retracements is leading us. It's leading us directly to an Ichimoku cloud. Is it raining? Maybe it's raining over there. There's an Ichimoku cloud. We don't know. Maybe it's raining. But we can't ignore the golden arches of the MACD. The MACD golden arches over here, right? What is the MACD golden arches telling us? Maybe it comes back around. Maybe it comes back around and it follows the MACD golden arches. This could be trouble, guys. What about possible ballet bands? What if we have ballet bands over here interacting with us? This could be some kind of a scenario, guys. What about, we can't forget the most important thing. We didn't draw any triangles. Okay, forget everything else, guys. It's all about the triangle. I think you can see where this one's going. Ready? Let's go. Let's talk about technical analysis and exactly why we don't do it on this channel. There are a lot of different reasons for that, not the least of which being that intellectually, technical analysis just sucks. Technical analysis is super old. The whole candlestick chart analysis thing is usually credited to Hanma Morihisa, who was trying to analyze rice markets in Osaka, Japan in the 1700s. It's not surprising that this whole thing is pretty old when you consider that the human impulse to try to make sense of unpredictable chaos is also very old. I mean, this is why astrology exists. This is why tea leaf reading exists. This is why palm reading exists. Humans have always strived to try to make sense of unpredictable chaos. While mentioning technical analysis in the same breath as things like tea leaf reading and palm reading would seem like blasphemy to a lot of other crypto YouTubers, I think the top of this article kind of sums it up for me. Research on whether technical analysis offers any benefit has produced mixed results. As such, it has been described by many academics as pseudoscience. So here's the big problem. Since the 1970s, we've had this hypothesis about markets, the efficient market hypothesis. It basically says that past prices cannot be used to profitably predict future prices. And in the peer-reviewed journal article in 1970 that kind of kicked this whole thing off, they found that the evidence in support of the efficient markets model is extensive and somewhat uniquely in economics, contradictory evidence is sparse. Of course, as with all things in academics, there are proponents and antagonists, and the antagonists here would say, yeah, maybe in a perfect market, the efficient market hypothesis is correct, but we have markets full of irrational, illogical investors, and they have expectations that price trends, things observable from past prices will continue, and that psychology leads them to invest or not invest. And in that way, markets aren't perfect. So, we've got technical analysis that embodies, all of this illogical stuff. Of course, the proponents of that model have a response. They say, hey, we're not just dealing with one investor. in a market like an equities market or a crypto market, we've got a whole bunch of investors. And while a lot of them may be acting in illogical ways, based on incomplete information, you're going to have investors like that on both sides of every possible decision. So while you might have optimists thinking the price is going to go up based on their incomplete information. You'll also have pessimists thinking the price is going to go down based on incomplete information. And the net result is that the whole cadre of investors sort of embody complete information. And that's how you still arrive at an efficient market. And then you've got even further refinements of this based on logic, like the random walk hypothesis from Princeton economist Burton Malkiel. He said that technical forecasting tools such as pattern analysis must ultimately be self-defeating. The problem is that once such irregularity is known to market participants, people will act in such a way that prevents it from happening in the future. This makes sense, right? If everybody is looking at the same, sort of pattern analysis TA, and everybody sees some formation and they're like, hey, this is the signal. This is the signal. Price is going to go up. Then everybody rushes into that position. That causes other formations, other signals that the equity or crypto or whatever is now overbought. Now it's overbought. Everyone's position suddenly becomes, oh no, we have to get out of this trade, right? And the market corrects. And you've got people trading on different timelines here. So while some people might see the first part of that when everybody rushes into the trade because of the technical analysis as a bullish signal, there are other people trading on a slightly longer timeline, and they're going to say, okay, the market is going to have this like small blip up, but then it's going to correct back down. And maybe the correction back down, might be bigger than the correction up, or maybe it's the same. So somebody trading on a slightly longer timeline might see this as a non-signal, or maybe even it's a bearish signal if they think the fall back down is bigger than the move up. In the aggregate, while the intended holding periods of all these different traders might be different, somebody might be trading, on sort of a day trader level. Somebody might be trading on like a weekly basis. Somebody might be trading a monthly, yearly basis, because their holding periods are all different, but they might all be acting. They might all be acquiring or disposing of the stock right now. In the aggregate, it's easy to see why Malkiel would say that this pattern analysis in TA will ultimately be self-defeating, because in the aggregate, all those things are cutting against each other, grinding against each other, and there's not going to be any clear sort of signaling data, because people are trading on different timelines and interpreting things differently, and they're all affecting the market. So it's understandable just by pure large logic why Malkiel came to the conclusion that TA will always ultimately be self-defeating. And again, he's compared technical analysis to astrology. Of course, we're talking about academics here. So, some academics found a way to try to clap back, and it's all very mixed, But what's really interesting is that even when people who aren't proponents of the efficient market hypothesis or this random walk hypothesis, when they're trying to demonstrate some value in technical analysis, they might do like, sort of a historical regression analysis of a certain indicator, and usually it's something, very technical, and it's not just like, the very simple visual formations that most YouTube crypto people, are looking at. But even when they find these very technical indicators, and they do this big regression analysis to show like, oh, this technical indicator was accompanied by this tiny incremental, on average over the last 50 years in the equities markets, there has been, it has had this tiny incremental predictive value, because that does happen sometimes. It's like when other academics look at that finding, very often what they find is that even if there is some tiny incremental predictive value, it would have been eaten up by trading fees for any normal trader, right? Just like the friction in making a trade, whether you're a retail investor using the highest cost, trading platform, or a more institutional investor, using a, much, 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 much cheaper, method of trading. It's like there are always costs. There are always these costs to trading. And what happens a lot of times, even when they do show that over the last 50 years, there was this tiny incremental, predictive value in some very, very technical indicator, it's always so small that the trading costs would have far outweighed the predictive value of that indicator. I shouldn't say always, but every time I look at this issue, that always turns out to be the case. So we've got this discipline, technical analysis, right? That is it's hard to argue it's not a dubious predictive value, especially when fees are taken into account, right? It's like even if you want to make the argument that it is of predictive value, when you take the fees into account, it's very difficult to say that someone could take technical analysis and that would be a profitable use of their time, as far as like gaming the market, right? It's debated, right? There's not a consensus that it's actually of any value, right? That's the first big problem, right? And that's a pretty huge problem. So why is this so common in crypto, right? You turn on like, a huge proportion of crypto channels and you see this. Guys are talking about Ichimoku clouds, Fibonacci's, Fibonacci retracements, all kinds of moving averages, and they're drawing a lot of triangles, right? A lot of Bollinger Bands, a lot of triangles, identifying a lot of channels, a lot of, a lot of blood diamonds, all kinds of stuff with these candles. Why do we get this, right? It's because it's convenient, right? A lot of these YouTubers, they're trying to make videos, every day, every other day, several times a week. And it's hard to come up with fundamental things to talk about, but the chart is always there. The chart is always there. You've always got this. Every day you wake up, you could pull a new daily candle and talk about what that daily candle means. And you've got all these little tools in your toolbox, the Ichimoku clouds, the Bollinger Bands, the Fibonacci retracements. You've got all these tools you can talk about, and you can make a video about that every single day. It's really convenient, and people eat it up, right? People are either about to make an investment decision or they have already made an investment decision and they want comfort. Psychologically, they need comfort in that decision. It feels good. It hits those hormone buttons, right? They get that dopamine hit like, oh yeah, I made the right decision. The Bollinger Bands agree. This Ichimoku cloud is letting me know scientifically I made the right decision, right? People eat it up. So YouTubers love to do it because it does push those dopamine buttons that people investing in crypto want to be pushed. So why don't we do this on this channel? It would be way easier for me to wake up every day and just pull up the chart and say, today I'm going to talk about Fibonacci retracements. Today it's going to be Bollinger Bands. Tomorrow it'll be Ichimoku clouds. That would be way easier. I wouldn't have to do any research on real topics about real things. It'd be way easier just to pull up the chart and have this big segment of the video every day be this technical analysis charting segment. People love it, right? They want you to push those dopamine buttons in their brain. They want that. But I do not want to manipulate anybody with their brain chemistry, right? I don't want to do that. I want to talk about real things, the real things driving crypto. And also, I don't want to give you financial advice or investment advice because the history of crypto has been one of booms and busts. I don't want to tell you whether you should or should not invest in anything, right? I just want to talk about Cardano. I want us to have these conversations about Cardano, what's actually going on in the ecosystem, what other projects are doing, what little mini projects within the Cardano ecosystem are doing, where we might go, where we should go, where we are going. These are intellectually interesting and stimulating conversations, right? Me drawing triangles on a chart, even though it feels like it's intellectually stimulating because of the brain chemistry thing it's doing, it's not really intellectually satisfying. It's not a good intellectual pursuit, right? I'm not saying guys like Raoul Pal, he'll draw a line sometimes on a graph and say, "Hey guys, look, I just figured out that this asset hasn't dropped below this trend line since 1992, and it just dropped below that trend line, right? That's something you should be aware of. I'm not discrediting the genius of guys like Raoul Pal because he occasionally draws a line on a graph. But what I am saying is that there's a gigantic difference in how intellectually stimulating a conversation about what's actually happening in the real world is versus drawing triangles on charts. Also, to be frank, I'm not totally sure it's legal. I don't even have to cherry pick here, right? Every state in the United States is concerned about regulating financial advice and investment advice. I could cherry pick and pick a state that is likely to have very, very strong and high levels of regulation. I could pick like California. Instead, let's pick one of the states that you might predict has like some of the best regulation, some of the most lenient regulation. In fact, we know it has the most lenient regulation towards crypto in general. Let's pick Wyoming. Let's look at what Wyoming says about giving advice on investments and stuff like that. So right here on the Wyoming Secretary of State's website, it says, it is unlawful for any person to transact business as an investment advisor or an investment advisor representative in Wyoming unless they are registered or exempt from registration. Where have we seen this language before, right? Everything in securities law is registration or exemption from registration. This is the norm. If we go to their FAQ, it says, does my firm need to be registered? In most cases, if you accept a fee or commission for providing investment related advice, you are required to register. Is there a de minimis rule? It says, if you don't have a place of business in Wyoming, the de minimis exemption does not apply. If you're from another state and you've had 5 or more people in Wyoming as clients, registration is required. Any given YouTube channel could have easily had more than 5 people listening from any specific state in the last 12 months. But that doesn't answer the question. What exactly is the business of an investment advisor that causes you to have to be registered in some of these states? So here's what Wyoming says in the actual Wyoming statutes. Here's the definition of an investment advisor: a person that for compensation engages in the business of advising others either directly or through publications or writings as to the value of securities or the advisability of investing in, purchasing, or selling securities. There's a bunch of other clarifying language here, and of course you would have to go through and pick out each of these terms and look at the definitions of each of these terms, so it becomes quite complicated trying to determine who is actually an investment advisor. But when you look at the enumerated exceptions down here, or exemptions from this definition, not a single one of them mentions YouTuber. And guys, this is the most crypto-friendly jurisdiction in the entire United States. Can you imagine California? If you've got a YouTube channel, you've probably had more than 5 people from California listening to you. And they are likely to be a lot stricter than Wyoming. So these crypto YouTubers who are doing all this charting stuff, like enter this crypto here, here's a good exit point here, I think this is a good buy here. That sounds a lot like investment advice to me. And I don't think these statutes are written right now to have exemptions for YouTube. These crypto YouTube chart guys should be worried about this. If some state securities regulator or the SEC turns around and says, hey, that token or coin you talked about on your channel is a security, I don't know how they get out of this. And I mean, the requirements, if you are an investment advisor in a particular state, they're pretty significant. In some cases, you have to have a bond In some cases, you have to file a registration documents. You might have to take an examination. Like it's they have significant requirements to actually be an investment advisor. Like it's an occupation, right? It's a profession. It's not something you just sort of check a box and you're good as a YouTuber. So they should be worried about this. But more so, I think the bigger reason that people shouldn't be using technical analysis to push those hormone buttons in people's brains is because in crypto we have this history of ballooning asset prices and busts, right? That's been the history of crypto. And all this hormonal manipulation that the charting accomplishes in people's brains, man, if I were one of those guys, when those balloons break, I wouldn't want to know that I was responsible for hyping a bunch of people into, buying at this price point, sell here, buy here, buy here. I think we're going to hit this level. I think Cardano is going to go to this level, because those people are going to go to those YouTubers after it's all said and done and say, hey, I bought Cardano because of a video you made that got, 175,000 views or whatever, where you predicted, $10 Cardano. I bought because of that video, and now my life savings are gone. For all these reasons, we don't do technical analysis on this channel. The Cardano ecosystem is really exciting, and I want to have these discussions about the Cardano ecosystem with you, but I don't tell you what to do with your money. I don't tell you to buy this coin, sell this coin, any of that kind of stuff. You decide what to do with your money. I'm never going to pretend to be able to tell you what the price is going to be at any given point in the future or what the markets are going to do. We're just going to have interesting conversations about emerging bleeding edge technology that exists in this Cardano ecosystem. Talk to you tomorrow.